This week on the Danny Moses Show, I'll show you why tracking the Dow Jones Industrial Average, known as the Dow, is not an accurate measure of broad market performance and really only serves as a marketing gimmick at this point. I am thrilled to welcome Peter Boockvar, the Chief Investment Officer of One Point PFG Wealth Partners and author of the Boock Report on Substack, to the show. And while Super Bowl 60 is behind us, I hope you tuned in last week for my Kalshi predictions. There are more predictions to discuss in the form of Kalshi event contracts.
Over 30 years of beating Wall Street, predicting the famous Big Short. Now, he's here for you. This is the Danny Moses Show.
Welcome to the show. Every week we will help make sense of the most important and impactful events happening in the markets, and I will do my best to break it down for you in a way that both informs and entertains. That's what you can expect here on Scripps News, so let's get to it. There are many ways to track the stock market, and it seems to grow daily as ETFs now outnumber stocks in the United States. But the most followed and tracked indices are the S&P 500, the NASDAQ Composite, and of course, the Dow Jones Industrial Average, affectionately known as the Dow. As the Dow crossed 50,000 for the first time last week, I thought it would be a good time to discuss what it is, how it was constructed, and why it's both relevant and irrelevant as a market barometer. Let me start with a little background. The Dow Jones Industrial Average made its debut in 1896 and was the brainchild of Charles Dow, who along with Edward Jones launched the Wall Street Journal several years earlier in 1889. It was originally comprised of 12 stocks with a focus on industrial companies, given their importance at the time. While investing in stocks in the late 19th century was common, it was dominated by the wealthy and connected financiers. It became more widespread during the Roaring '20s before the 1929 crash, which, for better or worse, cemented the Dow as the market barometer. The S&P 500, originally called the Standard 500, was created in 1957. And while it was also heavily focused on industrials, it represented over 90% of total U.S. stock market value. From its inception, the index was market cap weighted, taking both price and shares outstanding into account, unlike the Dow, which is calculated on price alone. Let me give you an example. Goldman Sachs, whose stock price is around $950, the highest of the 30 stocks in the Dow, has a market cap of $285 billion, but moves the index more than Apple stock, whose price is $270 and has a market cap of $4 trillion. A 10% move in Goldman Sachs would equate to around 95 Dow points, and a 10% move in Apple would be around 27 points. Yet a 10% move in Apple would represent roughly $400 billion in value, is bigger than the entire market cap of Goldman Sachs. One other quick example of two more Dow components: Walmart is roughly 3 times the size of Home Depot in terms of market cap, yet Home Depot's weighting in the Dow is 3 times larger than Walmart because its stock price is around $390, or roughly 3 times larger than Walmart's of just under $130. I hope that proves my point. So why is the Dow still so widely used as a measure of stock market performance? Well, the original Dow Jones & Company, acquired by News Corp in 2007, owned several financial publications, including the Wall Street Journal and Barron's, and also benefited from the creation and trading of index-linked products such as ETFs, futures, and options, until it sold its remaining rights in the index to a joint venture between S&P and the CME Group in 2013. The State Street managed DIA ETF alone has almost $50 billion in assets, and State Street pays a fee to that joint venture to license that index. I don't see a scenario where either the Wall Street Journal stops talking about the Dow or the index providers stop licensing the rights. So while it might be a prestigious honor for companies to be included as one of the 30 stocks in the Dow, investors looking for proper market weight diversification should look to the S&P 500, where, you guessed it, all 30 Dow stocks are included. When we come back, my conversation with Peter Boockvar and what you need to know about the latest job numbers.
The Danny Moses Show is sponsored by Kalshi.
Peter, thanks so much for coming on the Danny Moses Show. It's great to have you. Before we get into your background and all the work that you do, I want to get the soundbite, which happened on Wednesday when the U.S. jobs report came out.
Non-farm payrolls for January coming in twice expectations at 130,000. 130K, that would be the juiciest going back to April of last year when it was 158.
All right, so Peter, you do a great job of breaking down headlines like that and then looking kind of underneath the hood for what's really going on. What's your takeaway from that, just the headline number that we saw yesterday on the jobs number?
So that headline number includes government. government actually cut jobs. So of the 130, 137,000 came from the healthcare and social assistance area, showing again that most of the jobs are coming from sectors that are immune to economic gyrations. Whereas if you look at the more the cyclical things like leisure and hospitality, retail, financial services, information, there was no job growth there. There was job growth actually in construction, but we can tie that into data centers. And for the first time since November 2024, there was actually job growth in manufacturing, but just by 5,000 people. So when you look at this jobs number, yeah, headline, we can sound like Rick, but under the hood, it's a much more differentiated, uneven, mixed jobs picture.
And just to add to that, the unemployment rate was lower than expected also. Explain to people how the household survey and the drop of jobs, adding of jobs kind of changes that, moves that around.
So the establishment survey, the government surveys actual companies. Did you hire? Did you fire? Household survey, they're literally calling people up and saying, do you have a job? Do you not have a job? Were you hired? Were you fired? The unemployment rate is measured off that household survey. So what we saw in the January number was an increase in the household survey that exceeded the increase in the labor force, hence the decline in the unemployment rate by 1/10 to 4.3%.
All right, now a little more about you. So I start my day normally Wall Street Journal headlines, FT headlines, and then the Boock Report, which you've been writing for several years on Substack. You're an economist, you're a strategist, you kind of do it all. What led you to start kind of writing that? I know you've been on various firms on Wall Street. We knew each other back then as well, but you really dedicated yourself to kind of get, and I know you're up late at night and early in the morning because by 7:30 a.m., I know what's happened in Japan around the world. So talk about that a little bit, and I think you're a great source of information.
Thank you. So when I was on the sell side, I started writing as a strategist, and I just felt that, well, yeah, I did it for the purposes of helping my clients, but also to help me collate my thoughts. And then I went to the buy side and I felt, hey, let me just continue doing this because I still have to do the same amount of work. I do a lot more work now on the micro level in digging into company earnings calls. And I felt by writing every day, it allows me to sort of bring together, collate all my thoughts, and not just to create a product that readers can read, but also for me, really help organize my thoughts on a daily basis.
So let's talk about that because one of the issues going on, it's not just the United States markets that matters, right? It's what's going on in China, what's going on in Japan. Let's talk about Japan for a minute because I like to compare sometimes the balance sheets of what we have here. Granted, our debt to GDP is not as high as it is in Japan. People misunderstand the, quote, carry trade. They don't want to pay attention to it. They're probably right. We've had several iterations where something happens in Japan, it impacts our market for a little bit, you try to explain it, I try to explain it, then it kind of goes away. But there are structural issues that global central banks have basically created, right? Talk about that a little bit and why we should care about what goes on around the globe and how it impacts stocks here in the United States.
Well, I always like to tell people the world is one big cobweb and we are connected in one way or the other. And if what happens there doesn't matter today, eventually it still could matter. And you take Japan, you take the Bank of Japan. The Bank of Japan is the architect for modern day monetary policy with experimenting with balance sheet expansion and zero interest rates. Ben Bernanke thought it was such a great idea, he said, hey, let me use that here. And the Europeans said, wow, Ben, you're a genius. Let's even take it one step further, and we're going to go negative interest rates, and then eventually spiral back to Japan. So here we have a situation where the Bank of Japan got rid of yield curve control. And I argue that that was the catalyst that sent the U.S. 10-year yield to 5% from about 3.5%. We've obviously since come off that, but to me, it was a boomerang. What happened there had a direct impact here. Fast forward to today, Japan has an inflation problem to the point where Takaichi is the prime minister because the populace is upset with inflation and they decided to kick out the previous PM, Ishiba. That is forcing now the Bank of Japan to, still kicking and screaming, to raise interest rates. It matters in Japan because Japan is a massive holder of foreign assets. They own an enormous amount of treasuries. They are the largest foreign holder of U.S. treasuries, totaling about $1.2 trillion. But they also own a lot of U.S. stocks. So what matters there matters a lot here if the yen really starts to rally. So I'd be really paying attention to that currency. And I will do the cobweb thing again. Because what happens in China could, in fact, affect what happens with the yen. Because quietly, the Chinese yuan is rallying. to the highest level versus the dollar since May 2023. It's got the longest weekly winning streak in 13 years. And a rally in the Chinese yuan doesn't happen by accident. It happens because the Chinese officials want it. So if the Chinese yuan rallies, it gives cover for other Asian currencies to rally, including the yen. So if the yen all of a sudden is 150, 145, 140, you are going to see major global shifting of trade and capital flows that I think everyone will pay attention to, because everyone's going to be affected by it.
So we probably just went a little too deep, but I think just for people to understand, pay attention to what's going on around the world, because it does have an impact. You sift through all of that stuff, and then you kind of look at sectors within the U.S. markets and globally where you would allocate money. What might be kind of expensive, and we're going to get into that in the technology trade and AI-related stocks. What might be cheap, some of the materials and energy stocks, which you and I talk about all the time. Where are you seeing the best opportunities to kind of put money right now in the U.S. stock market by sector? And then maybe some specific companies, if you want to mention them or not, I don't know. So,
yeah, so full disclosure, everything I'm going to say we own, and it's not investment advice. It's just telling us what we're doing. The two groups that I really like are energy, oil and gas stocks, and consumer staple stocks. Two of the most hated groups in the market coming into this year. Energy was 2.9% of the S&P coming in. Consumer staple stocks had an awful year last year, deservingly so. They lost pricing power, margins got squeezed, there was very little growth. But it got to the point where valuations eventually do matter. And all you need for a successful investment is to have a bad situation get less worse. Plus, the consumer staple stocks pay tremendous dividends, bond-like dividends with equity-like upside. Back to energy, to me, a barrel of oil at around $60, $65 is probably one of the cheapest assets in the world. 20 years ago, oil was $60. You inflation adjust oil $60 20 years ago to today, it'd be $100. So to me, there's a lot of upside relative to the downside. And I think the downside is relatively capped. You get into the 50s, half of U.S. shale stops making money. I think the Saudis are done with this decline in oil prices because of the budget squeeze they're experiencing. So if you can buy stocks that at the bottom of a pricing cycle are generating earnings and cash flow and paying nice dividends, just imagine what these companies are going to do when oil prices are much higher, and gas prices as well. So to me, those are the most attractive areas of the market right now. But I think commodities in general, I mean, I'm going to steal Jeff Curry's line. We're seeing a revenge of the old economy. We are seeing the Gen AI tech trade outside of memory and storage is clearly running out of gas. And I think in terms of market dominance that we've seen over the many years, that trade is over. Not that these stocks can't work, not that these companies aren't great, but in terms of their ability to carry the markets, that's over. And investors need to find a new blueprint for the next couple of years.
Let's talk about that more. Why is it over? I mean, we're pulling forward a lot of good news in the AI sector, kind of in tech. The technology sector became such a heavy weighting in the S&P. It still is. Your point about just money coming out of that sector a little bit and going into things like energy create a huge upside when historical weightings of energy within the S&P 500 have been 6 to 7%. That's kind of the median, and I'm sure we're approaching 4 here because we've had a nice little run here. But what is the catalyst to get people to realize that there's other things other than tech stocks and that they're a little bit expensive? And I also want to go into the kind of the debt that's been issued here within the sector. We're getting into that.
So I think it really started, and just for context, coming into 2025, the Mag 7 trade was not just a successful investment in the U.S., it was a global phenomenon. The whole world piled into these stocks to the point where these 7 stocks became a reserve asset. You're the Swiss National Bank, you're the Norwegian Central Bank Asset Management Division, you own U.S. Treasuries, and you own Mag 7. So coming into the 2025, you had the late January news about DeepSeek. And people all of a sudden said, hey, the U.S. is not the only game in town in developing these models. China is a player as well. And obviously, this trade got hit hard. It did get a second wind in the back half of 2025. But coming into 2026, people are realizing that these business models are getting transformed from a very asset-light business model to a very capital-heavy one, a very high cash flow, free cash flow generating business to almost no free cash flow anymore. And also just the whole ecosystem that's been created around it, yeah, maybe that still has some legs because we're still going to be putting up more data centers. Obviously, there's a major supply-demand imbalance in memory. But these hyperscalers are not the same free cash flowing business models anymore, and investors are now coming around to that fact. The problem for the market is they are the market in terms of concentration. So I think that is really the catalyst here. It's not necessarily a technical thing. It is a fundamental reassessment of the profitability of these companies.
It doesn't seem like bond investors have lost their appetite for it. We've seen hundreds of billions of dollars being issued. We see a 100-year bond out there now, right, being issued out there. So how do you explain that divergence between people thinking the balance sheets are going to be safe? I know equity and bonds are very, very different. Is that a safer way to play? And I also wanted to say in general, and I might lose some people here in the audience, but credit spreads in general, where these bonds trade versus U.S. Treasuries, are historically extremely tight, meaning you're not getting much of a yield over. And I could argue that no one wants to own U.S. Treasuries. They'd rather own corporate. But give me your thoughts on that. And do you see that slowing down at all as a catalyst to then maybe hurt some of these stocks in tech land?
I think that's just a sign, obviously investors are still very comfortable with the underlying businesses. That while the bottom line may not generate much free cash flow, the top line is still very strong, and these companies are still very profitable before you reach the depreciation expense line. So I think buying these bonds, investors are comfortable that they're going to get paid back. And to your point you just made, to an extent, people are saying, you know what, I'd rather lend money to Google and Microsoft than the U.S. government.
So the other sexy word out there other than AI has been private credit, or the two words I should say, and it's found its way to retail investors. And I always say as a retail investor, when you get the opportunity to invest in something that only institutions have had, you should ask, why am I getting this opportunity to kind of do this? Talk about what's happening in private credit, why retail investors should look carefully or tread carefully as they're going to look to invest in it, and what we've seen kind of trigger a sell-off in some of these private credit companies as it relates to software companies and the kind of the private software companies that are out there and having issues.
So I always felt the natural sort of symbiotic relationship between private equity, private credit as investors in these things and those that invested in those private firms. They were very aligned with respect to time horizon. If you're an insurance company, an endowment, a pension fund, you were willing to give them your money for 7, 8, 9, 10 years because there was no pressure on you to get that money back outside of, obviously, distributions as the years would progress. But that sort of money flow has slowed down because the pace of monetizations at the private equity side has slowed dramatically, and private equity credit decided, hey, we need to tap a whole new area of money, and what pool of money is bigger than wealth management money, retail money? But the problem is that retail's time horizon, to me, does not line up with private equity, private credit. So that retail person says, okay, yeah, I'll give you my money for 8 years, but when push comes to shove, when markets turn down, and they're told by their advisor, hey, sorry, things are tough because that retail person wants their money back, I don't know if I'm going to be able to get it back for you so soon. And I wouldn't be surprised if in a couple of years, these private credit guys and equity guys are going to be hauled up in front of Congress, and they're going to say, why did you tap into retail? Because there will be a time when things are getting tough, and these retail people want their money back, especially if you're a boomer and you're thinking about retirement, and your advisor told you, hey, don't worry about the markets. It's not mark to market. You're not going to get the same volatility, and then all of a sudden that person needs their money back. So I think that's where a push will come to shove, and that's going to be an issue. Then to your other point, are we beginning to see credit issues in private credit, particularly with software? Since software makes up about, I've seen statistics of 15 to 20% of that private credit universe. And maybe not yet, but they're beginning to be rumblings. There are also beginning to be rumblings that the private credit sponsors are beginning to give more room to their portfolio companies because these are financing issues or business issues. Because at the end of the day, private credit is just replacing a bank loan. They are lower quality loans, and we need to keep a close eye on the health of those loans.
All right, one other topic I want to get into is the Federal Reserve. And throughout your career, you've worked with some great, smart people, interesting people. Larry Lindsey was one of them at some point. What are your thoughts on the independence of the Federal Reserve and their role right now and how important it is in the markets and the economy?
So the Fed has never really been independent, particularly the governors that are based in D.C. They are just creatures of that city. The head of the Federal Reserve is a creature of getting calls every day from Congress, and the president, maybe not physical calls, but tweets, whatever. So there's always a political situation, whether it's political donations that these members make or whatever. So with Kevin Warsh, obviously there's going to be pressure for him to cut interest rates. Whether he really believes that he should or not, he's going to. Then we shift to the balance sheet. And there was this initial reaction, we saw it in gold and silver, of the day that he was appointed, and the initial reaction was, okay, Kevin Warsh is going to be this big hawk, he's going to shrink the balance sheet, and that'll help the dollar, and I don't want to own gold and silver. Kevin Warsh is not going to shrink the balance sheet, but he will be more judicious in using QE the next time, and that the thing that you pull on the wall, only pull in case of emergency, at least right now, Warsh is only going to pull the QE in case of emergency. But that said, he's going to cut rates. There's going to be pressure on him to do it. And when things hit the fan, maybe he just does QE because everyone's going to say, you got to do something.
Well, Peter, I can't thank you enough for coming on. People should subscribe to you on Substack, the Boock Report. And what you know, when we come back, I have some Kalshi event contracts to describe some of what you're talking about right now. So when we come back, my Kalshi event contracts of the week.
The Danny Moses Show is sponsored by Kalshi.
Welcome back to the Danny Moses Show. It's time for my Kalshi picks of the week. I hope you tuned in last week for my Super Bowl picks. Remember, when you were trading on Kalshi, you're trading with other users, similar to buying or selling a stock, and you can jump in or out of your position at any time to lock in a profit or cut your losses. I'm not sure I can top last week's predictions, which included a Seahawks win, Kenneth Walker III is MVP, and the mention of the word wind during the broadcast, but I will give it a shot. Okay, first Kalshi event contract I'm looking at is the next Fed meeting on March 18th. Odds for a rate cut dropped significantly this week after the stronger than expected jobs report. However, there is a lot of time between now and the next upcoming Fed meeting on March 18th. I see current odds for the Fed to cut rates at 7 cents, which is actually less than I see on CME Fed Fund futures. I don't see that dropping too much over the next few weeks and could easily see it move back up to 18 or 19 cents where it was just a few days ago. And remember, you can trade out of it. My second Kalshi event contract I'm looking at is somewhat related, which is looking at Jerome Powell staying on as Fed governor beyond his stint as Fed chair, which ends in May. He sounded somewhat resigned in his press conference a few weeks ago, and although his term as governor runs through January 2028, I think he might resign. There is a reason this contract is trading up at 70 cents, and I am buying it. The last Kalshi contract I'm looking at today is whether or not the S&P 500, remember the better measure for the markets than the Dow, will trade at or above 7,800 during 2026. As we sit here, the S&P is trading around 6950, and from here that would be a gain of just over 12%. While it certainly is possible any market downturn from here in the near term would make no, currently trading at 64 cents, trade higher. So I'm in the no camp there. These are just my opinions. I'm not telling you what to trade or offering any investment advice. So download the Kalshi app, read the rules, and use the promo code MOSES to get $10 when you trade $10. Back with my closing thoughts in a moment. Thanks again to Peter Boockvar for joining me on today's show. I hope you enjoyed this episode and now have a better understanding of the Dow, and while it's only one of many measurements you should use to track the health of the markets. I'll be back with you next week for another episode of The Danny Moses Show. In the meantime, you can follow me on various social channels, including on Substack, where me and my fellow Big Short partners, Porter Collins and Vincent Daniel, publish What Are We Doing? Contrarians at the Gate. And watch these episodes anytime on scripsnews.com/Danny Moses. So until then, I will keep an eye out in the markets for what everyone is talking about, what nobody is talking about, and what I think matters most to you. I'm Danny Moses.